most people are going to lose money in the next market crash, and the worst part is they won't even realize why it happened. They'll think it was bad luck, or the market was unfair, or they just didn't get out in time. But the truth is much simpler, and honestly a lot more uncomfortable. They lost money because they did what felt right in the moment. And I know that feeling, because I've been there before. I used to think crashes were something you had to avoid, something smart investors could step around if they paid enough attention. The idea sounded logical: you get out when things look bad, you come back when things feel safe again. It feels like control, like you're being careful instead of reckless. But the more I paid attention, the more I realized something didn't add up. The people who tried to control the market usually ended up with worse results than the ones who didn't. And that didn't make sense to me at first. So I started looking deeper, not just at what people say, but what they actually do when things go wrong. And what I saw was pretty consistent. When the market is going up, everyone feels like a long-term investor. But when things start falling, that confidence disappears fast. You start checking your portfolio more often, you feel that pressure building, and your brain keeps telling you to do something. Maybe sell a little, maybe wait it out, maybe just step aside for now. It all sounds reasonable when you're in that moment. But that's exactly where things break. Because investing is not just about what you buy, it's about whether you can stay in the game when it gets uncomfortable. Two people can have the exact same portfolio and end up in completely different places. Not because one is smarter, but because one panics and the other doesn't. One interrupts the process, the other lets it play out. And over time, that difference becomes massive. So I stopped asking what should I invest in, because that question wasn't the real problem. The real question was what is most likely to make me mess this up when things go bad. Because if I couldn't answer that, then none of the strategy mattered. And once I started looking at it that way, I realized something I didn't expect. The biggest risk in investing was never the market, it was my reaction to it. And once I saw that clearly, I realized I needed to understand the math, because if the numbers didn't support my behavior, then my behavior was the problem. So let's strip this down to something simple, because this is where most people get misled without even noticing it. Imagine you invest $10,000, nothing fancy, just a basic long-term investment, and in the first year you make 10%, now you're at $11,000, then the second year you make another 10%, and now you're sitting at $12,100. This is the part everyone understands: it feels steady, it feels predictable, and it makes investing look easy, like you just stay in long enough and everything works out. But that's not how it actually plays out over time, because at some point the market drops, and not a small drop either, something real, something that makes you uncomfortable. So let's say in year 3, the market falls 40%, which has happened before and will happen again, and now your $12,100 is no longer growing, it's down to about $7,260. That shift is not just a number, it's a completely different emotional experience, because now you're not thinking about growth anymore, you're thinking about loss. And this is the part that changed everything for me, because getting back to where you were is not as simple as reversing the drop. If you lose 40%, you don't need 40% to recover, you need closer to 67% just to break even. That gap right there is where most people lose years without realizing it, because losses hit harder than gains can repair. When I first understood that, it didn't feel like a small detail, it felt like the entire game flipped on me, because now every bad decision during a crash carries more weight than I thought. It's not just about being down temporarily, it's about how hard it becomes to recover from that position if you make it worse by reacting at the wrong time. And then I started looking at something else that made it even more uncomfortable, which is what happens when you step out of the market during those moments. There's this idea that you can just wait for things to calm down and come back later, but the data doesn't support that the way people think it does. Some of the biggest gains in the market don't happen during calm periods, they happen when things still feel unstable, sometimes right in the middle of a downturn. So if you step out to protect yourself, there's a high chance you miss those days, and missing just a few of them over a long period of time can drastically reduce your overall returns. That part really stuck with me, because it means you can go through all the same ups and downs as everyone else, take the same risks, deal with the same volatility, and still end up with a completely different outcome just because you weren't there at the right moments. That's when I stopped thinking about compounding as something automatic, because it's not. It only works if you stay connected to it. The moment you interrupt it, especially during high-impact periods, you're not just pausing your progress, you're damaging it in a way that takes years to fix. And the hardest part is, none of this feels obvious when you're in it, because the math is quiet, but your emotions are loud. So if you don't understand how these two interact, you end up trusting the wrong signal at the worst possible time, and that's how a system that should work for you slowly starts working against you. And once I understood how the math works against you, I had to face something even more uncomfortable, because the real problem was not the numbers, it was how I reacted to them. Your brain is not designed to build long-term wealth, it is designed to protect you from immediate threats in the moment. And most of the time, those two goals do not align when money starts going down. When your portfolio drops, your brain does not think about 10 years from now, it reacts to what is happening right in front of you. It sees loss, it feels danger, and it pushes you to do something about it. I have felt that shift myself, and it happens faster than you think. One day you feel calm and confident in your plan, and the next day you are checking your account more often than usual. You start paying attention to every small movement, and every drop feels heavier than it should. Your focus slowly moves away from building wealth, and shifts toward avoiding further loss. And without realizing it, your goal has already changed in the background. You are no longer trying to grow your money over time, you are trying to stop the discomfort you feel right now. That is where most people lose control, because they are no longer following a system, they are reacting to emotion. Your brain starts offering solutions that sound completely reasonable in that moment. It tells you to reduce your exposure, to step out temporarily, or to wait until things feel more stable again. And the dangerous part is that none of these thoughts feel emotional when you are thinking them through. They feel calm, logical, and even responsible, which makes them very hard to question. But underneath those decisions, there is something much deeper influencing you. Losing money feels significantly worse than gaining money feels good, and that imbalance changes how you behave. So when you are down, your decisions become biased without you even noticing it happening. You begin to prioritize short-term relief over long-term outcomes, even if that was never your original plan. And once that shift happens, your behavior starts working against your own strategy. Because investing is not just about making one correct decision, it is about staying consistent through many uncomfortable moments. If you step out of the market, you now have to make another decision later, and that decision is just as important. You need to know when to come back in, and that is where most people struggle even more. They leave when things feel the worst, and they return only when things start to feel safe again. By that point, a large part of the recovery has already happened without them. I started noticing this pattern everywhere, and it made me realize this was not a knowledge problem. Most people already understand that markets go up over time, but they do not have a system to handle themselves. And without that system, even a good plan will break under pressure. That is when my perspective changed, because I stopped trying to predict the market and started focusing on my own behavior. I realized I did not need a more complex strategy, I needed a system that could protect me from myself. And once I accepted that I needed a system to protect me from myself, the next question became very simple: what exactly should that system look like before things go wrong? Because the truth is, you don't fix your behavior in the middle of a crash, you prepare for it when everything still feels calm. When the market is down hard, you are not thinking clearly, and that is not the moment to rely on discipline. So I stopped looking for perfect strategies, and started focusing on building something that would still work when I felt uncertain. The first thing I put in place was something most people ignore because it feels boring. An emergency fund that I would not touch for anything except real-life situations. At first, it didn't feel like investing at all, because it was just sitting there doing nothing exciting. But over time, I realized it was the one thing that kept me from making bad decisions under pressure. Because when life gets unpredictable, and it always does at some point, you need cash. And if you don't have it, you are forced to sell your investments at the worst possible time. That is not bad luck. that is a weak structure showing itself at the worst moment. Having that buffer changed how I felt during downturns, because I knew I didn't have to touch my investments. The second thing I did was remove decision-making from my investing as much as possible. Instead of asking myself every month whether I should invest, I made it automatic. The same amount of money went into the market on a fixed schedule, no matter what was happening. This sounds simple, but it completely changed my behavior over time. When prices were high, I bought fewer shares without thinking about it too much. When prices dropped, I bought more shares without needing to convince myself it was a good idea. And during a crash, that system quietly does something powerful in the background. It increases your buying at the exact moment when assets are cheaper. The part that surprised me was how uncomfortable it still felt, even though I knew it was working. Because emotionally, buying when everything looks bad goes against your instincts. That is exactly why automation matters, because it keeps you consistent when your feelings are not. The third piece was something I thought I understood before, but I really didn't. Diversification is not just owning different things, it is making sure your risk is not concentrated in one area. I had to look at my portfolio honestly and admit where I was overexposed. Once I adjusted that, I added a simple rule to rebalance periodically. That means trimming what has done well and adding to what has fallen behind. It feels counterintuitive, because you are moving away from what looks strong. But over time, it forces a discipline that most people struggle to maintain manually. And more importantly, it keeps your entire system balanced instead of drifting toward risk. After putting these three things together, something changed in how I experienced investing. It stopped feeling like a series of decisions I had to constantly get right. And started feeling like a structure that could carry me through different conditions. Because when your system is strong, you don't need to rely on motivation or confidence. You just need to follow what you already decided when you were thinking clearly. And once I had that structure in place, something changed in the way I looked at money, because I stopped thinking about investing as a way to get ahead, and started seeing it as a way to avoid falling behind over time. I used to believe the goal was to be smart, to make the right calls, to find opportunities that other people missed. But the longer I stayed in this, the more I realized that mindset creates pressure, and pressure is exactly what causes people to break at the wrong moment. Because if your success depends on being right all the time, then one emotional decision can undo everything you built. The real goal is much simpler than that, but also much harder to stick to consistently. You don't need to be exceptional to build wealth, you need to avoid making big mistakes when things feel uncertain. Because the system itself already works, whether you believe it or not. Markets move in cycles, businesses grow over time, and value compounds quietly in the background. You don't need to force that process, but you do need to stay connected to it long enough for it to matter. And that is where most people fail, not because they lack intelligence, but because they underestimate how difficult it is to stay consistent. It is easy to commit to a long-term plan when everything feels stable and predictable. But that commitment gets tested when the market turns, when uncertainty shows up, and when your emotions start getting louder. I had to accept that I was not competing against the market, I was dealing with my own reactions to it. Once I saw that clearly, I stopped trying to impress myself with better decisions, and focused on building a process I could actually follow. That shift made everything feel less exciting, but much more stable over time. There is nothing flashy about this approach, and it will not give you quick wins or instant validation. But what it does give you is something most people never experience, which is consistency across different market conditions. Because when you remove the big mistakes, you allow the system to do what it was designed to do. And over time, that creates results that feel almost surprising, not because they are fast, but because they are steady. If you step back and look at everything we covered, the pattern becomes very clear. The market is not the real problem, and volatility is not the real risk you should fear. The real risk is breaking your own process at the exact moment when it matters most. So the goal is not to predict the next crash, and it is not to avoid every downturn. The goal is to build something strong enough that you don't have to rely on emotions when things get difficult. That means having stability in your life, having a system that keeps you consistent, and having a structure that can handle uncertainty. When all of that is in place, investing stops feeling chaotic and starts feeling manageable. And that is when real progress begins to show up, slowly but consistently over time. At that point, wealth stops being something you chase, and becomes something that builds quietly in the background while you focus on your life. So here is something I want you to think about, and I want you to answer honestly in the comments. When the market drops and things feel uncertain, do you trust your system, or do you trust your emotions in that moment? Drop your answer below so we can see how different people think about this. And if this helped you, subscribe to the channel and stay with me for the next videos.